Up to now, you have been learning how sales are recorded. Now we move to the customer side of the story, meaning how the business keeps control of who owes money, how much they owe, and whether they are paying on time. In real accounting offices, this chapter is not extra theory. This is daily work. And in the exam, it is a high-value chapter because it connects documents, ledgers, control accounts, and credit control procedures. What Chapter 13 covers, in a clear map. Topic 1. Personal accounts for credit customers. This chapter starts by explaining that the receivables ledger contains the personal accounts of credit customers, meaning each customer has their own account, showing sales made to them, meaning invoices, returns, meaning credit notes, payments received, and the balance still owing. So the chapter will explain why we need one personal account per customer, not just one total figure. The book highlights the practical reasons, such as a customer calls and asks, "How much do I owe right now?" The business sends statements of account to customers, often monthly. The business needs to check each customer's credit limit and credit position. The business must match payments against debts, so it knows which invoices are still unpaid. Topic 2. Authorization and credit control. The chapter then shows that before a business sells on credit, it needs authorization and procedures. This includes checking references and assessing whether the customer should be allowed credit, setting a credit limit, deciding whether to accept new orders when a customer is overdue. This is the business control side of receivables. In the exam, when you see the word authorization, think internal control and risk management. The risk is selling to people who will not pay. Topic 3. Recording transactions in the receivables ledger. This is where you will practice the mechanics. You will learn how to record sales invoices in the customer account, credit notes in the customer account, receipts, meaning payments, in the customer account, and you will learn what documents support those entries. Topic 4. The age analysis of receivables and other reports. Once we have customer accounts, we can produce reports. One key report is the aged receivables analysis. This is the report that groups customer balances by how long they have been outstanding, such as current, overdue by a short time, overdue by longer periods. Why this matters? It helps the business focus on collecting the oldest debts and managing cash flow. Topic 5. Irrecoverable debts and allowances for irrecoverable debts. Finally, the chapter deals with the reality that some customers do not pay. So you will learn what irrecoverable debts mean, how to record an irrecoverable debt, and why businesses create an allowance for irrecoverable debts, meaning an estimated provision for likely future bad debts. This is a classic exam area because it tests both understanding and double entry. How to succeed in this chapter, exam style. 1. Always separate two ideas. Receivables ledger, personal accounts. This shows individual customer balances. Trade receivables control account in the general ledger. This shows the total of all customer balances. A key exam skill is understanding how these two should agree in total. 2. Learn the documents and the direction. Invoice increases customer debt. Credit note reduces customer debt. Receipt reduces customer debt. If you master that, everything becomes easier. Now, if you're ready, we will start Lesson 1 of Chapter 13, Personal Accounts for Credit Customers. And we will build the logic step by step, like we are training for a real accounts assistant job and for the exam at the same time. All right, class. Now we explain only Lesson 1 of Chapter 13, Personal Accounts for Credit Customers. We will not do Section 1.1 yet. Lesson 1 is the foundation of the whole chapter. It answers a simple but very important question. If many customers buy on credit, how does the business keep a clear, organized record of what each customer owes? The answer is the receivables ledger, and inside it, personal accounts for each credit customer. What the receivables ledger is. The receivables ledger is the part of the accounting records that contains the personal accounts of credit customers. Think of it as a filing system, but it is a digital filing system in modern businesses. Each credit customer gets their own personal account. So the receivables ledger is not one account. It is a collection of many customer accounts. General ledger shows totals for the whole business. Receivables ledger shows the detail for each customer. What a personal account means in this chapter. A personal account is simply an account kept for a person or an organization. Here, the person is the customer. So a customer personal account is a running record of the relationship between the business and that specific customer. It shows every transaction that affects what the customer owes. What goes into a customer personal account? In this chapter, a customer personal account will normally show three big types of entries. 1. Sales on credit, meaning invoices. An invoice increases what the customer owes, so the customer account increases. 2. Sales returns, meaning credit notes. A credit note reduces what the customer owes, so the customer account decreases. 3. Payments received, meaning receipts. When the customer pays, what they owe reduces, so the customer account decreases. Invoice makes the customer balance go up. Credit note makes the customer balance go down. Receipt makes the customer balance go down. Why we need a separate personal account for each credit customer. This is the main purpose of Lesson 1, and you should learn it as common sense, not as memorization. Reason 1. The business must know how much each customer owes. If a customer calls and asks, "What is my balance right now?" the business must be able to answer immediately. Reason 2. The business must know what the balance is made of. The total balance is not enough. The business must know which invoices are still unpaid and whether there are credit notes or disputes. Reason 3. The business must send statements of account. Many businesses send a statement to each credit customer regularly. A statement lists invoices issued, payments received, credit notes issued, and the closing balance still owing. You cannot do this properly without a personal account for each customer. Reason 4. Credit control and credit limits. A business often sets a credit limit for each customer. If you do not have an individual account, you cannot control whether the customer is within their limit or exceeding their limit. Reason 5. Matching payments against debts. When a customer pays, the business must record that payment and match it against what the customer owes. Otherwise, the business might think a customer has not paid when they have, or allow more credit when the customer is actually overdue. The receivables ledger is about control. It protects cash flow. It prevents confusion. It reduces disputes. How this links to the general ledger. The receivables ledger is the detail. The general ledger contains a total account called the trade receivables control account. The control account is the total of what all customers owe. The personal accounts are the breakdown by customer. So the system should be consistent. If you add up all customer balances, the total should match the trade receivables control account. Control account is the summary. Personal accounts are the details behind the summary. A quick classroom picture of the flow. Imagine you have 3 customers. Customer A has an invoice, then a payment. Customer B has an invoice, then a credit note. Customer C has an invoice, no payment yet. Each customer account will show their own story. But the control account in the general ledger will show only one total figure. That is why Lesson 1 is important. It sets up the whole structure. Exam recommendations for Lesson 1. 1. Learn the definition in simple words. The receivables ledger contains the personal accounts of credit customers, showing what each customer owes. 2. When asked why we keep personal accounts, give practical reasons. Balance inquiry, statements, credit control, matching payments to invoices. 3. Do not confuse the receivables ledger with the general ledger. Receivables ledger is individual customer accounts. General ledger control account is the total. Class. Now we explain only Lesson 1.1 of Chapter 13, the need for personal accounts. This section is telling you why a business cannot manage credit sales properly if it only keeps one total figure for trade receivables in the general ledger. Yes, the trade receivables control account tells us the total amount owed by all credit customers. But the business also needs a record for each individual customer. That individual record is the personal account in the receivables ledger. The control account answers, how much do customers owe in total? The personal accounts answer, who owes what and why. Now the book lists several practical reasons. Let us expand each one in real office language and also in exam language. Reason 1. A customer may phone and ask what they currently owe. This is the simplest real-life situation. A customer calls and says, "Can you tell me how much I owe you right now?" If the business only has a total trade receivables figure, it cannot answer. It needs the customer's personal account to see which invoices are outstanding, which payments have been received, whether there are credit notes, and the current balance. In exam language, you say a personal account is needed so staff can tell the customer the state of their account. If you cannot answer a balance inquiry quickly, you look unprofessional and you lose control. Reason 2. Statements of account are sent to credit customers. Many businesses send a statement of account at the end of each month. A statement is not an invoice. It is a summary. It usually shows opening balance, invoices issued during the month, credit notes issued during the month, payments received during the month, closing balance still owing. To prepare a statement for each customer, the business needs each customer's personal account. Otherwise, it would have to manually search through many documents, which is slow and error-prone. In exam language, you say, personal accounts are needed to prepare statements of account for customers. Statements reduce disputes because they show the full story. What we billed, what you returned, what you paid, and what is still outstanding. Reason 3. Managers want to check the credit position of an individual customer. Credit position means the customer's situation in terms of how much they owe now, whether they are paying on time, and whether they are close to their credit limit. Managers need this information to make decisions, such as, should we allow this customer to place a new order on credit, or should we stop further credit until payment is received? So personal accounts support credit control. In exam language, you say, personal accounts help management monitor each customer's credit position and control credit limits. Teacher talk moment. Selling on credit is risky. The personal account is the tool that lets you control that risk. Reason 4. Matching payments against debts owed. This is one of the most important practical reasons. When a customer pays, the business must match that payment to what the customer owes. If payments are not matched, you get problems like the customer claims they paid, but the business cannot identify which invoice was paid. The business sends an unnecessary reminder letter, damaging the relationship. The business fails to chase a genuinely unpaid invoice because it thinks the account is settled. So the personal account is needed to record receipts and allocate them to outstanding invoices. In exam language, you say, personal accounts are needed to match payments received against the debts owed and to identify which items remain unpaid. Cash collection depends on good matching. If matching is weak, your receivables ledger becomes unreliable. A short summary of Lesson 1.1. The need for personal accounts exists because the business must be able to answer customer balance inquiries, send statements of account, monitor credit limits and credit risk for each customer, and match payments to outstanding invoices to identify what is still unpaid. Exam recommendations for Lesson 1.1. 1. Memorize the idea, not the wording. These are real business reasons. If you explain them clearly, you earn marks. 2. Use strong verbs in your answer. Tell, send, monitor, match, identify. 3. Always contrast total versus individual. Total is the control account. Individual is the personal account. We have now completed Lesson 1.1 only. If you want, next we can go to Lesson 1.2, Authorization, where the chapter explains the procedures a business uses before and during credit sales to protect itself from bad debts. Now we explain only Lesson 1.2, Authorization, in Chapter 13. This short section is actually a very important business control idea. The book is saying, if you sell on credit, you are taking a risk. So you must put authorization procedures in place to reduce the risk of not being paid. A credit sale is almost like a small loan to the customer. If you would not lend money to a stranger without checks, you should not give credit without checks. What authorization means in plain accounting office language? Authorization means permission given by the right person following the business rules. So it is not just someone said okay. It means the business has a policy. The policy says who is allowed to approve, and the approval is recorded so it can be checked later. Why do we need authorization when selling on credit? Because the business wants to ensure, as far as possible, that it will receive payment for the goods. The big risks of credit sales are: the customer cannot pay, the customer delays payment for a long time, the business accidentally gives too much credit, staff make mistakes, or even fraud by giving credit to the wrong customer. So authorization is part of internal control and credit control. Now, the book gives 3 main authorization procedures. Let us expand each one clearly. Procedure 1. Authorizing a customer to have a credit account. The book says that allowing a customer to have a credit account will require authorization. What this means in real practice: before a new customer is allowed to buy now and pay later, the business usually asks for information, such as the customer's full business name and address, contact details, the type of business they are in, how long they have been trading. Then the business asks for references. The book mentions 2 common types of reference: trade references from suppliers. This means the business asks other suppliers, meaning companies that already sell to this customer on credit, questions like, do they pay on time? Do they exceed agreed terms? Have there been disputes or returned checks? A bank reference. This is a basic check with the customer's bank, usually to confirm that the customer is known to the bank and appears creditworthy. This is the business asking, are you a trustworthy payer? Where the authorization fits. A credit controller, credit manager, or finance manager reviews the references and then approves or rejects the request for a credit account. The key is that it is approved by an authorized person, not automatically by the sales team. Why this is important for your exam. If the exam asks why authorization is needed, you say, to reduce the risk of irrecoverable debts and to ensure credit is only given to suitable customers. Procedure 2. Authorizing the customer's credit limit. The book says the customer's credit limit must be authorized, and it depends on the information gathered in Procedure 1. What is a credit limit? A credit limit is the maximum amount the business will allow a customer to owe at one time. So it is a control cap. For example, if a customer has a credit limit of $5,000, the business policy is: do not allow the customer's outstanding balance to go above $5,000 without special approval. How a business decides the credit limit. It depends on things such as how strong the references were, how financially stable the customer appears, how much they are likely to buy, the level of risk the business is willing to accept. Why credit limits matter? Because even good customers can become risky if they owe too much. A credit limit prevents one customer from becoming a huge exposure. A credit limit is like a fence. It stops the balance from running away. How the authorization works in practice. A manager sets the limit and records it in the accounting system. Then, when a sales order is entered, the system or the credit control team checks current balance plus value of the new order compared with credit limit. If the new order would take the customer over the limit, it is stopped for review. Procedure 3. Authorizing orders before goods are dispatched. The book says that before goods are dispatched, the order may need to be authorized by the credit control department. This is extremely realistic, because even if a customer was approved in the past, their situation can change. So before the business sends out goods, someone must check. Does this customer currently owe money? Are they within their credit limit? Are their invoices overdue for payment? The book gives a very important point. If the customer has invoices overdue, the business may decide that no further orders can be accepted until payment is received. What this means in practice, this is called putting the account on stop. It is the business saying, we will not supply more goods on credit until you pay what is already overdue. If you keep supplying a late payer, you increase the risk that you will never collect. How this links back to the receivables ledger. This is why customer personal accounts matter. Credit control needs to look at the customer's account and see what is outstanding, what is overdue, and whether the customer is keeping to terms. So Lesson 1.2 and the receivables ledger work together. The receivables ledger provides the information. Authorization procedures use that information to make safe decisions. Exam recommendation for Lesson 1.2. In the exam, you may be asked something like, state and explain authorization procedures for selling on credit. A strong answer is to write the 3 procedures in order, in simple business language. 1. Authorize opening a credit account using references, trade references, and possibly a bank reference. 2. Authorize a credit limit based on the information obtained. Set a maximum outstanding balance. 3. Authorize dispatch of goods by checking credit status. Stop further orders if invoices are overdue until payment is received. Common exam mistake to avoid. Do not write about double entry here. This lesson is not about debit and credit entries. It is about internal control and risk management in credit sales. Class, now we explain only Lesson 1.3, benefits and costs of offering credit facilities to customers. This lesson is not a double entry lesson. It is a business reality lesson. It is teaching you that selling on credit has 2 sides. One side is benefit, because credit helps sales happen. The other side is cost and risk, because credit can lead to late payment or no payment. Credit sales can increase profit on paper, but they can damage cash in the bank if customers do not pay quickly. What the book means by offering credit facilities. Offering credit facilities means the business allows customers to buy now and pay later. So instead of paying immediately in cash, the customer gets a period of time, such as a month, to pay. This is very common in real businesses, especially when businesses sell to other businesses. Benefits of offering credit facilities. Benefit 1. It helps the business make sales. The book explains that many businesses cannot expect immediate cash payment, especially in busy trading areas and competitive markets. If one business demands cash only, but competitors offer credit, customers may choose the competitor. So credit facilities can increase sales and help the business keep trading. Sometimes credit is not just a nice option. It is a competitive necessity. Benefit 2. It helps customers manage their own cash flow. Customers often need time between buying goods and selling them on to their own customers. Credit gives them breathing space, so customers prefer suppliers who offer credit terms. Benefit 3. It supports business-to-business relationships and repeat orders. Credit terms can create long-term relationships. A customer who knows the business offers reliable credit terms may order regularly. That stabilizes sales for the business. Benefit 4. The business can also obtain credit from its own suppliers. The book mentions an important real-life cycle. A business may sell on credit to customers and at the same time buy on credit from suppliers. So the business is trying to manage timing, money coming in from customers compared with money going out to suppliers. This is a normal part of cash flow management. Credit is a chain. Customers owe us, and we owe suppliers. The key warning in the book, delay in receiving money, can cause problems. The book says that ideally a business wants to receive money from its customers as quickly as possible. Why? Because delays create pressure. The business still has to pay wages. The business still has to pay rent. The business still has to pay suppliers. The business still has day-to-day expenses. So even if sales are strong, the business can face cash shortages if customers pay slowly. This is exactly why the next idea appears in the book, credit control. Credit control, the control system that reduces the risk as. The book explains that most businesses aim to control these problems by means of credit control. Credit control means the procedures used to decide who gets credit, set credit limits, monitor overdue balances, and chase late payers. The book gives 2 key tools inside credit control. Tool 1, credit limit. A credit limit is the maximum amount a customer is allowed to owe at one time. If a customer tries to place an order that would take them above the limit, the business should not allow the order to go through unless special approval is given. This protects the business from one customer building up a large unpaid balance. Tool 2, aged receivables analysis. This is a report that shows how long invoices have been outstanding. It helps the business identify slow payers and focus collection efforts. Aged receivables analysis is like a warning dashboard. It shows you where trouble is growing. Now, the costs of offering credit facilities. This is where the book becomes very practical. It says customers might fail to pay for reasons such as dishonesty, bankruptcy, meaning the customer's business collapses, foreign exchange control restrictions, meaning the customer may be prevented from sending money out of their country during the credit period. So, what costs can arise from giving credit? Cost 1. Interest costs of an overdraft if customers do not pay promptly. If customers do not pay quickly, the business may run short of cash. To keep operating, the business might use a bank overdraft. An overdraft is a situation where the bank account goes below zero and the bank charges interest. So slow customer payment can cause overdraft interest costs. Late customer payment can turn into bank interest expense for us. Cost 2. Costs of trying to obtain payment. Chasing payment takes time and money. It can include staff time in the credit control department, phone calls, letters, emails, reminder notices, and statements, sometimes using a debt collection agency. These are real costs created by credit sales. Cost 3. Court costs. If a customer still does not pay, the business may take legal action. Legal action can create court fees and legal costs. Even if the business eventually wins, it may spend money to get paid. Sometimes you spend money just to collect money that should have been paid already. What this lesson is really teaching you to say in an exam. This lesson often appears in the exam as a written question, not a numbers question. For example, you may be asked to explain benefits of offering credit to customers, explain costs or risks of offering credit, explain why credit control is needed. A high-scoring exam answer follows this structure. First, benefits. Credit can increase sales, improve competitiveness, and help customers manage cash flow. Second, risks and costs. Delayed payment can cause cash flow problems, bad debts, and extra costs such as overdraft interest, chasing costs, and legal costs. Third, control response. Credit control procedures are needed, including credit limits and aged receivables analysis to reduce risk and encourage prompt payment. Common student mistake to avoid. Do not write only one side. If the question asks about benefits and costs, you must cover both. Examiners want balanced understanding. All right, class, now we explain only lesson 1.4, the receivables ledger. This lesson is where the chapter becomes more mechanical and exam-friendly because it explains exactly what the receivables ledger contains and how entries in customer personal accounts connect to entries in the general ledger. What the receivables ledger contains. The receivables ledger contains the individual personal accounts of credit customers. Each personal account shows what that customer owes the business. So if you open one customer account, you should be able to see a history of invoices sent to that customer, credit notes issued to that customer, payments received from that customer, and the balance still outstanding. The receivables ledger is like a customer-by-customer storybook of debts and payments. How the receivables ledger connects to the general ledger. This is a key sentence idea in the book. When transactions are posted to the individual customer's ledger, the general ledger is updated at the same time. In a modern system, this usually happens automatically. Meaning, if you enter a sales invoice for a customer, the system will update that customer's personal account in the receivables ledger and the trade receivables control account and sales accounts in the general ledger. So both sets of records move together. Why this matters? Because the receivables ledger is the detailed record and the general ledger is the summary record. If they do not update together, totals will not agree and the accounting system becomes unreliable. A very important example idea from the book. The book gives an example like, for a sale of $1,000 to a customer, the accounts assistant would record debit trade receivables, that customer credit sales. Let us translate that into ledger language. In the general ledger, trade receivables control account increases, sales increases. In the receivables ledger, the individual customer account increases. So a credit sale causes the customer's personal account to show a debit entry because the customer now owes more. Now, here is the really important point: how a customer personal account is laid out. The book explains that the entries in a customer personal account follow a simple logic. When invoices are entered in the trade receivables general ledger account, they are also entered on the debit side of the relevant customer account in the receivables ledger. When entries are made in the bank general ledger account in respect of payments received from customers, or if goods are returned, the entries are made on the credit side of the relevant customer account. Let us expand that slowly and clearly. Debit side of the customer account. On the debit side of a customer account, you record anything that increases what the customer owes. The most common item is sales invoices, including sales tax, meaning the gross invoice amount. So debit side equals increase in customer debt. Credit side of the customer account. On the credit side of a customer account, you record anything that reduces what the customer owes. Two common items are payments received from the customer, credit notes, meaning returns or allowances. So credit side equals reduction in customer debt. Debit in the customer account means the customer owes us more. Credit in the customer account means the customer owes us less. Why invoices are debit in the customer account? In plain logic. A customer account is an asset type account from the business point of view because it represents money owed to the business. Assets increase on the debit side, so when the customer owes more, we debit their account. Why payments are credit in the customer account? When the customer pays, the asset reduces. Assets reduce on the credit side. So when the customer owes less, we credit their account. The T account picture the book is trying to give you. The book shows a simple T account idea. Debit side, invoices sent out including sales tax. Credit side, sales returns including sales tax. Payments received. This is very examinable. If you can reproduce that layout in your mind, you will not get confused when you start posting entries later. What the receivables ledger achieves for the business. Now let us step back and see why this is useful. The receivables ledger allows the business to know exactly how much each customer owes, know which invoices are unpaid, chase late payment effectively, and keep control of credit limits and credit risk. And it supports reporting, such as statements and aged receivables analysis, which you will cover later. Exam recommendations for Lesson 1.4. 1. Learn the rule for customer accounts. Invoices go on the debit side of the customer account. Payments and credit notes go on the credit side of the customer account. 2. Remember the word gross. Invoices include sales tax, so they are normally recorded as gross amounts in the customer account. 3. Always link receivables ledger to general ledger. In exam explanations, say, the receivables ledger contains individual customer accounts, while the general ledger contains the trade receivables control account, which is the total. Entries should be reflected in both. Common student mistake to avoid: do not mix up the customer account with the supplier account. For customers, debit increases what they owe. For suppliers, it is the opposite pattern because suppliers are liabilities. We will handle that carefully when we reach payables later. But for now, keep the customer rule clean. Now we explain only Lesson 1.5, personal accounts as memorandum accounts. This lesson is very important because it clears up a common confusion in computerized accounting systems. If we already record the double entry in the general ledger, what exactly is the purpose of the customer personal accounts in the receivables ledger? The big idea in Lesson 1.5. In some computerized accounting systems, the personal accounts of customers do not form part of the double entry system. Instead, they are memorandum accounts. A memorandum account is a record kept for information and control, but it is not part of the official double entry postings in the general ledger. Memorandum means a note for memory. So these accounts help you remember the detail, even if the double entry is recorded somewhere else. Why this happens in computerized systems. The book is describing an integrated system. In an integrated system, when you enter a sales invoice, the system automatically posts the double entry into the general ledger. For example, trade receivables control increases, sales increases, sales tax payable increases if sales tax applies. That is the true double entry. At the same time, the system also updates the individual customer record in the receivables ledger, so you can see the breakdown by customer. But here's the key warning. If we treated the customer personal accounts as part of the double entry as well, we might record the same transaction twice. So the system design often keeps the double entry in the general ledger and keeps the customer personal accounts as memorandum, meaning detailed information records. What the customer personal account shows in a memorandum style layout. In these systems, a customer personal account is often shown as a simple list that looks like invoices raised, meaning amounts the customer owes minus receipts received, meaning payments minus credit notes, meaning returns or allowances. And the result is the balance still outstanding. So you can still answer questions like, how much does this customer owe? Which invoices are unpaid? How much did they pay this month? But the official debit and credit system, the one that creates the trial balance, is driven by the general ledger postings. Teacher talk moment. General ledger is for financial statements and trial balance. Receivables ledger is for customer detail and credit control. A practical example, in plain words, let us imagine a customer called Cook Co. The customer account might show opening balance brought down, meaning what was already owed, one sales invoice added, one payment received subtracted, closing balance carried down. In a memorandum-style system, this customer account is a clear summary for credit control, but it is not used as a separate double-entry posting that affects the trial balance. The trial balance is affected by the control account in the general ledger, not by the individual customer listings. Why the system still needs memorandum customer accounts? Now you might ask, if it is not part of double entry, why keep it at all? Because the business still needs the detail for real-life management. Reason 1, customer queries. When the customer asks for their balance, you need the detail immediately. Reason 2, statements and chasing. You need to produce statements and reminders using the customer breakdown. Reason 3, credit control decisions. You need to see overdue invoices, payment patterns, and whether the customer is within their credit limit. Reason 4, matching and allocation. You need to match receipts to invoices, even if the general ledger posting is automatic. So memorandum does not mean unimportant. It means it is kept for control and information, not for the main double entry totals. How this fits with the control account idea. This lesson also connects to a major exam concept. The trade receivables control account in the general ledger is the summary total. The receivables ledger is the detailed list by customer. In a well-designed computer system, the total of all customer balances should match the control account balance because the system updates them consistently. Control account tells you the total. Memorandum customer accounts tell you the story behind the total. Exam recommendations for Lesson 1.5. In the exam, if you are asked about memorandum accounts, write 3 things clearly. 1. Definition. A memorandum account is kept for information and control, but it is not part of the double entry postings that produce the trial balance. 2. Why it is used in computerized systems. To avoid double counting, because the double entry is already posted in the general ledger. 3. What it is used for. To provide customer-by-customer detail for statements, chasing debts, credit limits, and checking what invoices remain unpaid. Common exam mistake to avoid. Do not say memorandum accounts are optional or not needed. They are needed for control. They are just not the place where the official double entry totals are created in some systems. Class. Now we move to Lesson 2 in Chapter 13, Recording Transactions in the Receivables Ledger. Important instruction reminder, in this lesson, we are not doing Section 2.1 yet. We are only learning the rules and the method. The worked example comes right after this, and it will feel much easier once today's method is clear. What Lesson 2 is really about. Lesson 2 is teaching you how to write the day-to-day customer transactions into the receivables ledger, meaning into the personal accounts of customers. So we are focusing on 3 everyday events. 1, the business sells on credit and issues an invoice. 2, the customer returns goods or gets an allowance, and the business issues a credit note. 3, The customer pays and the business receives money. Invoices create the debt. Credit notes reduce the debt. Payments settle the debt. The key idea: the receivables ledger is customer by customer detail. In the general ledger, we have the trade receivables control account, which is a total. In the receivables ledger, we have individual customer accounts, which are the detail. Lesson 2 is training you to post the detail correctly. If you can post correctly, then later you can produce statements, chase overdue invoices, check credit limits, and reconcile the total of customer accounts to the control account. What information we record for each entry? In a customer personal account, each posting normally includes the date, the details, meaning what the entry relates to, such as invoice reference, credit note reference, or receipt reference, the amount and the updated balance when you total the account. In exams, details matter. Invoice is not enough. Use the invoice reference if it is given. Now, the posting rules, clearly and slowly. Rule 1. Invoices go on the debit side of the customer account. When you issue a sales invoice to a customer on credit, the customer owes more. So we record the invoice on the debit side of that customer's personal account, and it is normally the gross invoice amount, meaning including sales tax if sales tax applies. Why debit? Because from the business point of view, the customer account is an asset. Assets increase on the debit side, so an invoice increases the asset, meaning the amount receivable. Rule 2. Credit notes go on the credit side of the customer account. When goods are returned or an allowance is given, the customer owes less. So we record the credit note on the credit side of the customer's personal account. Again, it is usually the gross credit note amount, meaning including sales tax if it is included on the credit note. Why credit? Because the asset is reducing, and assets reduce on the credit side. Rule 3. Payments received go on the credit side of the customer account. When the customer pays, their debt reduces, so the payment is recorded on the credit side of the customer's personal account. Why credit? Same reason. The receivable is reducing. Debit means customer owes more. Credit means customer owes less. The matching idea, the practical office purpose. Lesson 2 is not only about writing entries. It is also about matching. When a payment comes in, you must match it to the correct customer, and ideally to the correct invoice. That is how the business knows which invoices are still unpaid. If matching is done badly, the receivables ledger becomes unreliable, and you will waste time chasing customers who already paid. Lesson 2 also wants you to understand that every time you post to a customer personal account, there is a related posting in the general ledger. Let us say this in plain words. When you record a credit sale invoice, the customer account in the receivables ledger increases, and the trade receivables control account in the general ledger increases, and the sales and sales tax accounts in the general ledger also update. When you record a sales return credit note, the customer account reduces in the receivables ledger, and the trade receivables control account reduces in the general ledger, and the sales returns and sales tax accounts in the general ledger also update. When you record a payment received, the customer account reduces in the receivables ledger, and bank increases in the general ledger, and trade receivables control reduces in the general ledger. Receivables ledger is the detail book. General ledger is the totals book. A good system updates both, how you keep the ledger neat and exam friendly. When you post customer accounts, do these habits. Habit 1, write clear details. Use the customer name and the invoice or credit note reference. Habit 2, keep invoices and credit notes separate in your mind. Invoices are debit, credit notes are credit. Do not mix them. Habit 3, treat receipts as credit in the customer account. Many students accidentally debit the customer for a receipt. That is wrong for customers. Habit 4, be consistent with gross amounts. In customer accounts, you normally record gross because that is what the customer owes or is being credited. Common exam mistakes in Lesson 2. Mistake 1, putting a receipt on the debit side of the customer account. Fix, receipts reduce receivables, so they go on the credit side. Mistake 2, using net amounts in the customer account when the question is clearly gross. Fix, Customers owe the gross figure on invoices. Mistake 3. Recording a credit note as if it is a payment. Fix. A credit note is not cash. It reduces the debt, but it is still a separate document and must be recorded as a credit note. Mistake 4. Forgetting that the receivables ledger is customer by customer. Fix. Always post to the correct customer account, not to a general customer's account. Exam recommendation for Lesson 2. If you get a question that says, enter these transactions in the receivables ledger, do this fast plan. Step 1. Draw the customer accounts that are needed, one account per customer mentioned. Step 2. Post invoices on the debit side with date and invoice reference. Step 3. Post credit notes and receipts on the credit side with date and reference. Step 4. Balance each customer account. Carry down the balance if asked. Class. Now we do section 2.1, the example, sales transactions. This example can feel busy at first because the book is showing you 3 different things happening across 2 months, and then it shows the solution inside the general ledger. So I will slow it down and turn it into a clear classroom method. First, what the question data is giving us. The business is Hawkins Co. During April, credit sales invoices were raised to 3 credit customers, Turing Machinery, G. Wright, Simpsons. For each invoice, the table gives 3 amounts: net total, meaning sales value before sales tax gross total, meaning what the customer owes in total. Also during April, there were sales returns, credit notes. Again, net, sales tax, and gross are given. Then during May, cash receipts were received from customers who paid amounts owed. So April creates and adjusts the debts. May collects some of the debts. Now, the rule you must keep in your head before you touch the numbers. Rule 1. In the customer personal account, invoices go on the debit side using the gross amount. Rule 2. In the customer personal account, credit notes and payments go on the credit side using the gross amount. Rule 3. In the general ledger, we split gross into net and sales tax. Sales account gets the net, sales tax account gets the tax. Trade receivables control gets the gross one. If you follow these rules, you cannot get lost. Part 1. The invoices raised in April. Let us take the first invoice and do it slowly. Then you will see the pattern for all the others. Invoice on the 2nd of April to Turing Machinery. Invoice reference 2512, net is 244.79, sales tax is 48.96, gross is 293.75. What happens in the receivables ledger in the customer account debit? Turing Machinery personal account with 293.75. Why? Because the customer now owes more. What happens in the general ledger? Credit sales with 244.79. Credit sales tax with 48.96. Debit trade receivables control with 293.75. One invoice creates 3 postings in the general ledger, but only 1 posting in the customer's personal account because the customer only cares about the gross they owe. Now apply the same logic to every invoice in April. The book then totals the invoices for April. Total net sales for invoices is $4,807.69. Total sales tax on invoices is $961.54. Total gross invoices is $5,769.23. Pause and check understanding with me. If the gross is $5,769.23, what should trade receivables control increase by in April from invoices alone? Answer, by $5,769.23, because that is the total debt created. Part 2, the sales returns in April. Now we have credit notes, meaning returns. Credit note on the 23rd of April for G. Wright credit note reference 0084. Net is 215.4. Sales tax is 43.08. Gross is 258.50. What happens in the receivables ledger in the customer account? Credit, G. Wright personal account with 258.50. Why? Because the customer now owes less. What happens in the general ledger? This is the reverse effect of a sale. Debit sales returns with 215.42, debit sales tax with 43.08. Credit trade receivables control with 258.50. A credit note reduces what the customer owes, so it reduces trade receivables. It also reduces the net sales effect, so it goes to the sales returns account, not the sales account. The second credit note is on the 25th of April for Turing Machinery, credit note reference 0085. Net is 244.79, sales tax is 48.96, gross is 293.75. Totals for sales returns in April are: total net returns is 460.21. Total sales tax on returns is 92.04. Total gross returns is 552.25. Part 3. Cash receipts received in May. Now we collect cash. Receipts listed in May are: 7th of May, Turing Machinery pays 728.50. 14th of May, G. Wright pays 352.50. 14th of May, Simpsons pays 99.86. What happens in the receivables ledger in each customer account? Each payment is recorded on the credit side of that customer account because it reduces the amount owing. What happens in the general ledger? For each receipt, debit bank with the amount received, credit trade receivables control with the amount received. So total cash collected in May is 1,180.86. And that is exactly what the bank account in the solution shows as the balance carried down. Now let's interpret the solution. The book shows in the general ledger: 1. The sales account. The sales account is showing the net sales values for each invoice, added up. The balance carried down is 4,807.69. That is the total net sales from invoices in April. 2. The sales returns account. The sales returns account is showing the net returns values, added up. The balance carried down is 460.21. That is the total net returns from credit notes in April. In the income statement logic, net sales would be sales minus sales returns. 3. The sales tax account. This one is very examinable. The sales tax account has credit entries for sales tax charged on invoices, total 961.54. Debit entries for sales tax reduced on returns, total 92.04. So the net balance is 961.54 minus 92.04 equals 869.50. And the balance carried down is 869.50. Meaning, at the end of the period shown, the business owes 869.50 of output tax to the tax authority based on this set of transactions. This is exactly why the sales tax account shows a credit balance. 4. The bank account shows the receipts in May on the debit side. Total receipts are 1,180.86, which becomes the balance carried down. This is the moment where we prove the system is working. The total in the control account must equal the total of the customer balances. Part 1. The trade receivables control account, explained clearly. The trade receivables control account is the summary account in the general ledger. It answers one question only: how much do customers owe the business in total? In this example, the control account shows: on the debit side, the gross invoices raised in April, customer by customer, invoice by invoice. These entries increase trade receivables because customers owe more. On the credit side, two types of items appear. 1. Sales returns, meaning credit notes, which reduce what customers owe. 2. Bank receipts, meaning payments received, which also reduce what customers owe. Then the control account is balanced to find the closing balance carried down. The key number on this page is the closing balance carried down of trade receivables, 4,036.12. This means at the end of the period shown, customers still owe the business 4,036.12 in total. That figure is your target. When we total the customer balances, we must land on that same total. Why the control account is useful, but not enough by itself. The text under the control account is making a practical point. If you only look at the control account, you know the total owed, but you do not know who owes it. And in real life, the business needs to know which customer is late, which customer has the largest balance, who to chase first, and whether any customer is above their credit limit. So we need the receivables ledger, which is the detail. Part 2, the receivables ledger accounts, customer by customer. Now the book shows the individual personal accounts for the 3 customers. Remember the golden rule for customer accounts. Invoices are debits in the customer account. Credit notes and payments are credits in the customer account. Let us walk each one. Customer 1, Turing machinery debits, meaning invoices raised. Invoice 2512 for 293.75. Invoice 2515 for 728.50. So total debits are 1,022.25. Credits, meaning reductions. Credit note 0085 for 293.75. Bank, meaning payment received, for 728.50. So total credits are also 1,022.25. Result, balance is nil, meaning Turing machinery owes nothing at the end of this example. This is a perfect example of a customer who had invoices, then had a return and paid the rest. The account clears to 0. Customer 2, G-Write debits, meaning invoices raised. Invoice 2513 for 352.50. Invoice 2514 for 851.87. Invoice 2519 for 1,466.40. Total debits are 2,670.77. Credits, meaning reductions. Credit note 0084 for 258.50. Bank payment for 352.50. Total credits are 611.00. Customer 3, Simpson's debits, meaning invoices raised. Invoice 2516 for 99.86. Invoice 2517 for 1,692.00. Invoice 2518 for 284.35. Total debits are 2,076.21. Credits, meaning reductions. Bank payment for 99.86. So the remaining balance is 1,976.35, meaning Simpson still owes 1,976.35. Part 3, the reconciliation proof, the most important exam check. Now the book shows a simple list of who owes what. Turing machinery nil. Wright, 2,069.77. Simpson's, 1,976.35. Now add the 2 customers who still owe money. Careful, that must equal the control account balance carried down, which is 4,036.12. So what is happening? On the page, the control account balance carried down is 4,036.12, and the total of customer balances is also printed as 4,036.12. So the correct total is 4,036.12. In the exam, you do not argue with the page. You use the printed balances and show that the total of the personal accounts equals the control account balance. That equality is the reconciliation. If you ever find a difference in your own work, it usually means one of these mistakes happened. You posted a credit note to the wrong customer. You posted a payment to the wrong customer. You used net instead of gross in the customer account. You missed an invoice line. Part 4, the single column computerized format note. The book then tells you something practical. Many computerized systems do not show customer accounts in the old T account format. Instead, they show a single column running balance. How to read the single column format. Think of it like a bank statement for the customer account. Invoices appear as positive amounts because they increase the amount owed. Credit notes appear as negative amounts because they reduce the amount owed. Cash received also appears as negative amounts because it reduces the amount owed. The bottom line shows the balance outstanding. The example shown is for G-Write, and you can see the same events. Invoice 2513, Invoice 2514, Credit Note 0084 shown as a negative figure. Invoice 2519, Bank Payment shown as a negative figure. Ending with the same balance outstanding, 2,069.77. Different display, same accounting meaning. The system is still doing debit and credit logic behind the scenes. It is just presenting it in a simpler list for users. What you must be able to do for the exam. From the remaining part of section 2.1. 1. Explain the purpose of the control account and the receivables ledger. Control account gives the total. Receivables ledger gives customer detail. 2. Post invoices, credit notes, and receipts in customer accounts using gross amounts. Invoices on debit side. Credit notes and receipts on credit side. 3. Reconcile. Total of customer balances must equal trade receivables control account balance. 4. Do not get confused by formats. T-account format and single column format are two ways to present the same information. That completes the remaining part of section 2.1 only. Class. Now we explain lesson 2.2, the section summary. This part of the book is trying to do one very helpful thing for you. It is taking everything we just did in the example and turning it into a simple process map so you can see what happens in a computerized accounting system when a credit sale takes place. In the exam, when you can explain the process clearly, you score easy marks. This is not about heavy numbers. This is about understanding the flow, the starting point of the process. The process begins when the details of a credit sale transaction are input into the computerized accounting system. What details means in real life? It means information like customer name or customer account code, invoice date, invoice reference number, goods or services sold, net amount, sales tax amount, gross amount, any returns later using a credit note reference, any payment later using a receipt reference. The key idea: one entry, many updates at the same time. The diagram uses the phrase simultaneously updates. This is the heart of a computerized system. When you enter a credit sale, the system updates several places at the same time without you retyping the same information again. That saves time and reduces errors. Now let us walk through each box in the diagram in plain classroom language. Box 1. General ledger, trade receivables ledger account. This is the trade receivables control account in the general ledger. It is the total amount owed by all credit customers. When you enter a credit sale invoice, this total increases. When you enter a credit note or a customer payment, this total decreases. Why the diagram says this feeds into the financial statements? Because the control account balance is part of the accounting records used to prepare the statement of financial position, where trade receivables appear as an asset, and related figures that support profit calculations. Teacher talk moment. General ledger equals financial statements. So the control account must be correct. Box 2. General ledger, sales account, bank account, prompt payment discounts account, or sales returns account. This box is reminding you that the system posts the other side of the double entry into the general ledger as well. So the system updates accounts such as sales account. This records the net sales value. Sales tax account. The diagram does not list it in this box, but we saw it in the example, and it is part of the normal update. Sales returns account. If a credit note is entered, the system records the net return there. Bank account. When payment is received and entered, the system records the receipt in bank. Prompt payment discounts account. If the business offers a discount for early payment and the customer takes it, the system posts it here. This is a reminder that credit sales do not stay unfinished. Over time, you get returns, payments, and sometimes discounts, and the system is designed to capture all of them properly. Box 3. Individual customers' accounts in the receivables ledger. This box is the detailed customer-by-customer record. This is what you use for credit control and day-to-day customer management. The diagram says it is used to enable the business to establish the amount due from each individual credit customer at any point in time. That is exactly what we saw in the example. The control account told us the total owed. The customer accounts told us who owed what. If a customer phones and asks, "How much do I owe right now?" this is the record you check. Box 4. Sales invoice created, and also credit notes may be created. This box is describing the document output. In many systems, you do not write an invoice first and then type it in. Instead, you enter the transaction in the system, and the system produces the sales invoice document. If goods are returned later, the system can also produce the credit note. Then the diagram says the invoice is sent to credit customers. That is the practical purpose. Customers need the invoice so they know what to pay and by when. The invoice is not only accounting, it is communication. It tells the customer what they owe. Putting the whole process into one simple story. Let me tell the story in one straight line, like you would explain it in an exam. Step 1. Enter credit sale details into the accounting system. Step 2. The system produces the sales invoice for the customer. Step 3. At the same time, the system updates the general ledger, including trade receivables control, sales, sales tax. Step 4. Also at the same time, the system updates the customer's personal account in the receivables ledger. Step 5. Later, if there is a return, the system records a credit note and updates sales returns and sales tax in the general ledger, the customer account in the receivables ledger, and reduces the trade receivables control total. Step 6. Later, when payment is received, the system updates bank in the general ledger, trade receivables control in the general ledger, and the customer account in the receivables ledger. End result. The general ledger feeds the financial statements, and the receivables ledger provides customer-level detail for control and collection. Quick classroom checks to make this interactive. Question 1. If the trade receivables control account shows a total balance, what is the receivables ledger used for? Answer. You should say out loud. It shows the balance for each individual customer. Question 2. Why is simultaneously updates a good thing? Answer. You should say, it reduces duplication and reduces errors. Question 3. In the exam, if they ask where the statement of financial position figure comes from, which record do you name? Answer. You should say, the general ledger, specifically the trade receivables control account. Exam recommendations for Lesson 2.2. Recommendation 1. Learn the difference between summary and detail. General ledger control account is summary. Receivables ledger, personal accounts are detail. Recommendation 2. Use process language in written questions. Use phrases like entered into the system, invoice, produced general ledger, updated receivables ledger, updated financial statements produced. Recommendation 3. Mention internal control benefit. Computerized systems reduce duplicated work, but they still require correct input because wrong customer code or wrong amount will update everything wrongly. Common exam mistake to avoid. Do not say the receivables ledger creates the financial statements. It supports them, but the financial statements come from the general ledger. That completes Lesson 2.2 only. Class, now we move to Lesson 3 in Chapter 13, titled The Age Analysis of Receive and Other Reports. Let me frame this lesson in a very practical, office-based way. Up to this point, you have learned how a business records credit sales, returns, and receipts, and how it keeps customer personal accounts in the receivables ledger. That gives us a detailed record. Now, Lesson 3 asks a new question. So what do we do with all that information? Because the business does not keep receivables records just to be neat. The business keeps them to control credit, collect cash, and spot problems early. Lesson 3 is therefore about two big ideas. First idea, the age analysis of receivables. Second idea, other useful computerized reports that can be produced from receivables ledger data. Let us take them one by one, but still staying inside Lesson 3 only. Part 1 of Lesson 3. What is an age analysis of receivables? An age analysis of receivables is a report that summarizes how long customers have owed money. Think of it like this. Instead of reading every customer account line by line, the report groups outstanding amounts into time buckets, such as amounts up to 30 days old, amounts up to 60 days old, amounts up to 90 days old, amounts over 90 days old. Teacher talk moment. This is why it is called age analysis. We are aging the debt. We are asking, how old is each unpaid amount? Why businesses need this report? Imagine you are the credit controller. You have a long list of customers. Some pay quickly, some pay late, some are not paying at all. Without an age analysis, you would be guessing where the problem is. With an age analysis, you can immediately see how much of the total receivables balance is recent, which is usually normal, how much is older, which is more risky, which customers are creating the biggest overdue balances. So lesson 3 is really about turning raw ledger entries into a clear management picture. What information is the report built from? The age analysis is built from the receivables ledger data, especially invoice dates, outstanding invoice balances, credit notes that reduce balances, receipts that reduce balances. In a computerized system, the report is quick because the system already holds those details. Part 2 of Lesson 3, how the age analysis is used in plain English. Now I want you to hear this like a real workplace instruction. The age analysis is used to decide who to chase first. A sensible credit control approach is focus first on the oldest overdue balances, focus next on customers with large overdue balances. Check whether some items are in dispute. Check whether invoices were sent, received, and understood. Check whether the customer is near or over their credit limit. This is why the age analysis is not just an accounting report. It is a cash collection tool. It also helps management answer questions like, are receivables getting worse over time? Are customers paying slower than before? Do we have a growing risk of irrecoverable debts? Is the credit control process working properly? Part 3 of Lesson 3, other computerized reports. The book then reminds you that once the receivables system is computerized, it can print many other reports, not only the age analysis. The key idea is simple. If the data is entered correctly, the system can organize it and present it in different ways for different users. For example, the accounts team may need one type of report, while management may need another type of report, and customer service may need another. One very important point the book hints at is access and control. Because these reports contain sensitive customer information, businesses usually restrict who can produce them. That is an internal control point. So Lesson 3 is also quietly teaching you this exam-friendly principle. Computerized reporting is powerful, but it must be controlled through authorization and access rights. A quick interactive classroom check. Question 1. If you were a credit controller, which debts would worry you more? Very recent debts or very old debts? You should answer very old debts because the longer a debt is unpaid, the higher the risk it will not be collected. Question 2. What is the main purpose of an age analysis? You should answer to show how long debts have been outstanding so the business can chase and manage receivables. Question 3. Why does the business restrict access to receivables reports? You should answer because customer balances and customer details are confidential and the reports affect credit control decisions. Exam recommendations for Lesson 3. Recommendation 1. Learn the definition and the purpose. In the exam, you may be asked to explain what an age analysis is and why it is useful. Your best structure is what it shows, how it is used. Recommendation 2. Link it to credit control and cash flow. Markers love answers that connect receivables management to cash. Always remember, slow collection equals cash flow problems. Recommendation 3. Mention internal control. If you see words like computerized reports, customer data, or access, mention authorized staff only, restricted access, and good controls. Common exam mistake to avoid. Do not describe the age analysis as a list of customers. It is not simply a list. It is a structured summary that groups balances by how old they are, so management can make decisions. That completes Lesson 3 only. All right, class. Now we go to Lesson 3.1. What does the age analysis look like? This lesson is mainly about learning to read the report layout, because in real offices and in the exam, you will often be given a table like this, and you must understand what each column is telling you. What is this report? In one sentence. An age analysis of receivables is a schedule that lists each credit customer and splits what they owe into time bands based on how long the debt has been outstanding. When the report is prepared and why the heading matters. At the top, you will see words like age analysis of receivables as at, followed by a date. That as at date is the key anchor. It means we are taking a snapshot on that date, and we are asking for every customer how old is the unpaid amount on that date. So always do this first in your head. Step 1, identify the as at date, because every aging band depends on that date, the main columns you see, and what each one means. Column 1, account number. This is simply the customer code. It helps the system and staff identify the customer quickly and avoid confusion between similar names. Column 2, customer name. This is the customer's name. Column 3, balance. This is the total amount the customer owes at the as at date. Teacher talk moment. This balance is not just one invoice. It can be made up of several unpaid invoices, minus any credit notes, minus any payments already received. Now the aging columns, the heart of lesson 3.1. You will then see several columns with headings like up to 30 days, up to 60 days, up to 90 days, over 90 days. These are the time bands. But here is the part that students often find confusing, and the book is trying to warn you about it. When the schedule says up to 60 days, it does not mean everything from day 1 to day 60 again. It is shorthand. It means amounts that are more than 30 days old, but not more than 60 days old. Similarly, up to 90 days means more than 60 days old, but not more than 90 days old. And over 90 days means older than 90 days. So think of the columns like these 4 buckets. Bucket 1, up to 30 days. Newer debts, usually the least worrying. Bucket 2, more than 30 and up to 60 days, starting to become overdue depending on the credit terms. Bucket 3, more than 60 and up to 90 days, more overdue, higher risk. Bucket 4, over 90 days, very overdue, highest risk, needs urgent chasing. How the numbers get into the correct column. Now let us make the logic very clear. For each unpaid invoice, the system calculates how many days old it is at the as at date. Example explanation, using the book's style. If an invoice was raised 14 days ago, then that unpaid amount goes into the up to 30 days column. If an invoice was raised 36 days ago, then it goes into the up to 60 days column, meaning the second bucket. If an invoice was raised 75 days ago, it goes into the up to 90 days column, meaning the third bucket. If an invoice was raised 100 days ago, it goes into the over 90 days column. This is why the report is powerful. It is not only telling you who owes money, it is telling you how long they have owed it. How to read one customer line correctly. Pick one customer row. You will see their total balance in the balance column. Then you will see that balance split across the aging columns. Very important check. The total balance should equal the total of the aging columns for that customer. So in your mind, you always do this check. Balance equals bucket 1 plus bucket 2 plus bucket 3 plus bucket 4. If it does not match, something is wrong in the report or you are reading it incorrectly. What the totals and percentages at the bottom are telling you. Most age analysis schedules then show a totals row and sometimes a percentages row. Totals row. This adds up all customers and shows the total receivables split into the same aging buckets. Percentages row. This shows what proportion of the total receivables sits in each bucket. Why percentages matter? Because management do not only care about the total amount owed, they also care about quality. If a large percentage is in the over 90 days column, it usually means collection problems and higher risk of irrecoverable debts. Quick interactive class questions. Question 1. If most of the total receivables is in the up to 30 days column, is that usually good or bad? You should say, usually good, because the debts are fresh and likely to be collected. Question 2. If the over 90 days column is high, what does that suggest? You should say, slow paying customers, possible disputes or potential irrecoverable debts, and urgent credit control action is needed. Question 3. If a customer has balance, but all the aging columns are blank, what do you suspect? You should say, either a printing error or you are not looking at the correct row, because the balance must be made up of some age category. Exam recommendations for lesson 3.1. Recommendation 1. In written questions, explain the shorthand clearly. Use phrases like, up to 60 days means more than 30 days, but not more than 60 days. Recommendation 2. Always mention the as-at date. A strong exam answer always anchors the logic to the report date. Recommendation 3. Use the balance check. In an objective test question, they may try to trick you with a table where totals do not match. Train yourself to check that balance equals the sum of the aging columns. Common exam mistake to avoid. Do not age the debt using the payment date. Aging is based on how long the invoice or the outstanding amount has been unpaid as at the report date. That completes Lesson 3.1. All right, class. Now we move to Lesson 3.2. How is the age analysis used? This is where the book turns the report into action. In other words, Lesson 3.1 showed you what the report looks like. Lesson 3.2 shows you how a business uses it to manage receivables, protect cash flow, and reduce bad debts. Let us treat this like a real credit control meeting. What is the purpose of using the age analysis? The age analysis is used to help decide which debts to chase first and what type of action is needed for each customer. Credit control is not only about being strict, it is about being smart. You do not want to waste time chasing customers who are not overdue while ignoring the customers who are seriously late. So the age analysis helps you prioritize. How the business reads the report, left to right. The book tells you to read the columns starting from the column furthest to the right and then work across. Why? Because the right side holds the oldest debts, and those are usually the most urgent. So the practical order is, first, over 90 days, then up to 90 days, then up to 60 days, then up to 30 days. The basic idea is, older equals riskier. What kinds of situations does the age analysis help you identify? The book gives several real workplace reasons why debts might be old. Let us expand each one clearly. Situation 1. Some items may already be dealt with by correspondence, meaning the business may already have sent letters, emails, or reminders. So the credit controller uses the report to check which accounts are already in the chasing process and which still need attention. Practical example. A customer may have been sent a reminder last week, so today you may not chase them again. Instead, you might chase a different customer who has had no contact yet. Situation 2. Some older invoices may still be in dispute. A dispute means the customer is not refusing to pay for no reason. They are saying something like, the goods were damaged, the quantity was wrong, the price was incorrect, the invoice was not authorized, a credit note is expected but not yet processed. In the exam, the word dispute is very important. It tells you that chasing alone might not solve it. The business needs to resolve the issue, issue a credit note if needed, or correct the invoice. So the age analysis highlights the problem. But the solution may require action from sales, customer service, or the warehouse, not only accounts. Situation 3. Some customers may be in financial difficulties. This is a polite way of saying the customer may be struggling to pay. Now, in real business, that changes the strategy. If a customer is struggling, the business may stop giving further credit, reduce the credit limit, ask for cash on delivery for future sales, agree a payment plan, take stronger action if needed. Teacher talk moment. Notice how this links to internal control. A business must not keep selling on credit to a customer who is clearly not paying. So the age analysis is also a warning signal for credit policy. Situation 4. Some invoices might be old because of errors or missing follow-up. Sometimes the debt is old not because the customer is dishonest, but because the invoice was not received, the invoice was sent to the wrong address, the purchase order number was missing, the customer cannot match the invoice to their records, the accounts department on the customer side is not cooperating. So a good credit controller uses the age analysis to ask, is this a real overdue debt or an administrative problem? This is why the book mentions the need for a firm commitment about payment. Meaning, do not accept vague promises like, we will pay soon. Instead, you try to get a clear date and method. A very useful extra point the book mentions. Sometimes a column listing customer credit limits appears on the age analysis. This makes it easy to see which customers are close to their credit limit, have exceeded their credit limit. Teacher talk moment. This is extremely examinable. Why? Because it links the age analysis to credit control decisions. If a customer is over their credit limit and they are also overdue, the business should usually block further credit sales until payment is received. What decisions can management make using the age analysis? Now let us list the main decisions clearly, because the exam often asks state two uses or explain how it is used. Decision 1. Chasing priorities. Oldest and largest balances are chased first. Decision 2. Assessing overall collection performance. If a large proportion of receivables is old, the business is collecting slowly. Decision 3. Reviewing the effectiveness of the credit control department. If debts are getting older, it may indicate weak chasing procedures or poor follow-up. Decision 4. Estimating risk of irrecoverable debts. Very old debts are more likely to become irrecoverable, so management may become more cautious. Decision 5. Deciding whether to change credit terms. For example, shorter credit periods, stricter credit limits, more checks before granting credit. Interactive classroom check questions. Question 1. If a customer has a large amount in the over 90 days column, what should your first question be? You should say, is the amount in dispute, or is it simply unpaid with no valid reason? Question 2. If most customers are paying within up to 30 days, what does that suggest about receivables control? You should say, collection is healthy and credit control is likely working well. Question 3. If an invoice is old because the customer claims they never received it, what is the best first action? You should say rescind the invoice, confirm the correct address and reference details, and agree a clear payment date. Exam recommendations for Lesson 3.2. Recommendation 1. When asked how age analysis is used, always mention prioritizing chasing. Recommendation 2. Use the keywords dispute, financial difficulties, and credit limit. These are high-value exam phrases. Recommendation 3. Link it to cash flow. Say clearly, slow collection causes cash flow pressure. Recommendation 4. Add one internal control point. Stop further credit sales to customers who exceed credit limits or are seriously overdue unless authorized. Common exam mistake to avoid. Do not say the age analysis shows profit or shows sales. It does not. It shows outstanding receivables grouped by age to support credit control and collection. That completes Lesson 3.2. All right, class, now we are on Lesson 3.3, Other Computerized Reports. In the book, this lesson is basically saying, once a business uses a computerized receivables ledger package, it can print many helpful reports, not only the age analysis. These reports support credit control, customer service, and management decisions. Also notice an important control point the book mentions. Access to these reports is often restricted. Why? Because receivables information is sensitive. It includes customer balances, payment history, and sometimes contact details. So, in a well-controlled business, only authorized staff can print or view certain reports. Now let us go through the main reports one by one in a clear, practical way. Report 1. Statements of account. What it is. A statement of account is a document sent to a credit customer, usually at the end of each month, showing the opening balance, invoices raised during the period, credit notes issued during the period, payments received during the period, the closing balance owed. Teacher talk moment. Think of it like this. An invoice asks for payment for one sale. A statement summarizes the whole relationship over a period. Why it is useful. It helps customers check what they owe and why. It also helps the business reduce disputes because the customer can see the list of transactions. Real-life example. A customer says, "We already paid." The statement helps you point to the exact invoice and the exact payment, and you can quickly see whether the payment was actually received and allocated. Exam angle. You may be asked, what is the purpose of sending statements of account? A strong answer mentions reminding customers to pay, reducing queries and disputes, supporting credit control and collection. Report 2. Sales tax analysis. What it is. This report analyzes sales tax charged on sales, often split by different tax rates if the business sells goods or services with different rates. Why it is useful. It helps the business. Check that sales tax has been calculated correctly. Summarize sales tax collected for reporting and payment to the authorities. Spot unusual patterns or errors. Teacher talk moment. Even if you are not doing the full tax reporting in this level, you must understand why the report exists. Accuracy and control. Tax errors are expensive. Exam angle. Common wording is, explain how computerized reports help internal control. Sales tax analysis is a perfect example because it supports checking and compliance. Report 3. Sales analysis. What it is. Sales analysis is a report that breaks sales into categories that the business chooses. For example, by product type, by customer, by sales representative, by region, by month. The book calls this the configuration of the system, meaning the system is set up to analyze sales in the way management wants. Why it is useful. Management uses it to understand what is selling well, which customers are most valuable, which products are growing or declining, whether sales targets are being met. Teacher talk moment. This connects back to earlier lessons about coding. Good coding leads to good reporting. If codes are wrong, the sales analysis becomes misleading. Exam angle. If you are asked why coding matters, mention it allows sorting, grouping, and analysis in reports like sales analysis. Report 4. List of customer accounts. What it is. A list of customer accounts is a summary list of customers, often showing balances, and it may be filtered. For example, the business might print a list that only shows customers who have exceeded their credit limit or who are overdue beyond a certain age band. Why it is useful. It gives the credit controller a quick target list. Instead of reading every single customer line in a full age analysis, they can focus on the customers who need action now. Teacher talk moment. This is like switching from a full report to a priority view. Exam angle. If asked how a business prioritizes credit control work, mention using filtered lists such as customers over credit limit or customers with old debts. Report 5. Customer mailing lists. What it is. A mailing list is a list of customer names and addresses pulled from the receivables ledger. The book makes an important point. This can be a powerful marketing tool because receivables records are often kept up to date. Why it is useful. The business can use it to send promotions, new product announcements, seasonal offers, general communications. Teacher talk moment. In practice, marketing and account systems sometimes connect. The receivables ledger already contains contact details, so it can be used to produce a mailing list quickly. Exam angle. This is less about double entry and more about understanding the wider business uses of accounting systems. In objective test questions, they may ask, which report would help marketing contact customers? Report 6. Customer communication. What it means. This is a broad idea. Good record keeping and reporting helps the business communicate properly with customers. Why it is useful. When a customer calls and asks, what do I owe? Which invoices are outstanding? Why have you stopped my credit? The accounts team can respond quickly and accurately using system reports. This is not just about being polite. It prevents errors, reduces disputes, and improves collection. Strong communication supports strong cash flow. Exam angle. If asked about benefits of computerized receivables systems, include better and faster customer service, clear information for chasing and dispute resolution. Quick interactive check questions. Question 1. Which report is best for reminding customers of the full list of invoices and payments over a month? Answer, you should say the statement of account. Question 2. Which report helps management see sales performance by product or by customer? Answer, you should say sales analysis. Question 3. Which report helps a credit controller quickly identify customers who exceeded their credit limit? Answer, you should say a list of customer accounts filtered to show those over credit limit. Exam recommendations for Lesson 3.3. Recommendation 1. Always link each report to a purpose. The exam rewards report plus use, not just naming the report. Recommendation 2. Use office language. Say things like chasing overdue accounts, resolving disputes, reminding customers, checking tax calculations, and supporting management decisions. Recommendation 3. Mention control and restricted access. That is a strong professional point and fits the book's message about authorization. class. Now we go to lesson 3.4, the list of customer accounts. This sounds simple, but it is one of the most practical tools in a receivables ledger system, especially for credit control. Think of it as your quick dashboard of customers, instead of a long, detailed report. What a list of customer accounts is. A list of customer accounts is a printed or on-screen list of the credit customers in the receivables ledger, usually showing key summary information such as customer name and customer reference, current balance owed, sometimes the credit limit, sometimes whether the customer is overdue, sometimes the age status, for example, whether they have debts over 30 days, over 60 days, or over 90 days. The age analysis is detailed and can be long. The list of customer accounts is often shorter, faster, and can be filtered to show only what you need. Why the business uses this report? The main reason is speed and prioritizing. In a real accounts office, you do not have time to open every single customer account every day. So the list of customer accounts helps you do 3 jobs quickly. Job 1, identify who owes money. You can immediately see the customers with balances. Job 2, identify who is risky. If the list shows overdue status or age bands, you can spot customers with older debts. Job 3, support credit control decisions. If the list shows credit limits, you can spot customers who are near their limit or have exceeded it. How it supports credit control in real life. Let us walk through a typical day in a credit control office. Step 1, print or view the list of customer accounts. This gives a full picture of who is on the ledger. Step 2, filter the list to focus on priority customers. For example, you might filter to show only customers with balances over a certain amount, customers with debts over 60 days, customers who have exceeded their credit limit, customers who have stopped paying recently. Step 3, take action using the filtered list. This is where the report becomes powerful because it directs your time and your phone calls. Practical examples of how the list is used. Example 1, customers over their credit limit. If a customer's balance is higher than their credit limit, that is a warning sign. What the business may do: stop further credit sales until payment is received. Ask for a part payment request, cash on delivery for the next order. Get authorization before accepting new orders. This is a key internal control point. A credit limit is not decoration. It is a control tool. Example 2, identifying slow payers. If the list includes overdue information, you can quickly identify customers who are consistently late. What the business may do: shorten their credit terms, tighten the credit limit, increase the frequency of statements and reminders. Example 3, supporting the sales team without losing control. Sales staff often want to keep selling. Credit control wants to protect cash. A customer account list helps the business have a fair conversation. This customer is already overdue and near the limit. Do we really want to supply more on credit? So the report supports good decision-making, not emotional decision-making. How this links to the receivables ledger and the general ledger. Remember our big picture. The receivables ledger contains individual customer accounts. The trade receivables account in the general ledger contains the total. The list of customer accounts is basically a summary of those individual customer balances. So it helps you answer this important question: which customers make up the total trade receivables figure? In the exam, they love the idea of control and reconciliation. The list of customer accounts supports checking because it summarizes the details behind the total. Internal control and confidentiality point. The book mentions that access to receivables reports may be restricted. That applies strongly here because a customer account list may reveal balances, credit limits, payment behavior. So a well-controlled business will limit access to authorized staff only. Exam focus: how to answer questions on this lesson. If the exam asks something like, state 2 uses of a list of customer accounts, strong points include to identify customers who owe money and the size of balances to help prioritize credit control work by focusing on overdue or high balance customers, to identify customers who have exceeded or are close to their credit limits to support decisions about stopping further credit sales or requiring authorization. Common exam mistake to avoid. Do not confuse this with a statement of account. A statement of account is sent to the customer and shows transactions over a period. A list of customer accounts is mainly an internal report for the business to manage the ledger and manage credit. Quick classroom check questions. Question 1. If you want to quickly find which customers have exceeded their credit limit, which report is most direct? Answer, you should say, the list of customer accounts, especially if it includes credit limits and can be filtered. Question 2. If management asks, what customers make up our trade receivables total, what report helps you answer quickly? Answer, you should say, the list of customer accounts. Question 3. If the list shows many customers close to their credit limits, what is a sensible control action? Answer, you should say, require authorization for further credit sales or tighten credit terms depending on policy. Class. Now we explain lesson 3.5, the customer mailing list. This lesson looks small, but it is very realistic. It is showing you that once customer details are stored in a computerized receivables ledger, the system can produce lists that are useful beyond pure accounting, especially for communication and marketing. What a customer mailing list is. A customer mailing list is a report that contains the contact details of customers held in the receivables ledger, such as customer name, address, and sometimes phone number and email address, if the system stores them. The idea is simple. The receivables ledger already holds customer details, so the business can use the system to produce an accurate list quickly. Teacher talk moment. If the customer record is updated regularly, the list is likely to be up to date. That is why the book says it can be a powerful tool. Why the business produces a mailing list. There are two main purposes. Purpose 1. Credit control communication. The business can use customer details to send statements of account, reminder letters, overdue notices, confirmation of balances if required. So the mailing list supports the collections process. Purpose 2. Marketing and customer communication. The business can send product announcements, special offers, price list updates, seasonal promotions, general business updates. This is why the book links the mailing list to marketing. Teacher talk moment. Accounting systems often support business activity, not only bookkeeping. A receivables ledger is a customer database as well as a ledger. What makes this report different from the list of customer accounts? The list of customer accounts focuses on balances and credit control information, such as who owes money. The customer mailing list focuses on contact details, so the business can communicate with customers efficiently. So if you are asked in an exam, which report helps you contact customers? You choose the mailing list, not the list of balances. Internal control and confidentiality, a very important point. Now we must talk about control, because this is where examiners like you to show professional thinking. Customer details are sensitive information. So a good business will control who can access the mailing list, who can print it, who can export it, and how it is used. Just because the system can print a list does not mean everyone should be allowed to print it. This is linked to authorization in earlier lessons. Only authorized staff should have access to customer data reports. Practical risks, the book is hinting at. Risk 1, misuse of customer information. If staff can freely access customer addresses, the information could be misused. Risk 2, reputational damage. Customers do not like their details being handled carelessly. Risk 3, data accuracy problems. If customer master data is not updated, the mailing list becomes unreliable, and letters go to the wrong place. So, for the business, the lesson is keep customer records accurate and control access to reports. How this appears in the exam. This lesson usually appears in short written questions, such as state 2 other reports a receivables system can produce. Explain how computerized receivables systems support marketing or communication. Explain why access to receivables reports should be restricted. A strong exam answer would say, the receivables ledger system can produce a customer mailing list containing customer names and addresses. This can be used to send statements and reminders for credit control, and also to send promotional material for marketing. Access should be restricted to authorized staff because customer information is confidential. Quick classroom check questions. Question 1. If a business wants to send reminder letters to overdue customers, what report helps it get the addresses quickly? Answer: you should say, the customer mailing list. Question 2. If a business wants to send a promotion to all credit customers, what report helps? Answer: you should say, the customer mailing list. Question 3. Why should access be restricted? Answer: you should say, because customer details are confidential and must be controlled. That completes lesson 3.5 only. Class, now we explain lesson 3.6, customer communication. This lesson is about one practical truth. Managing receivables is not only about ledgers and balances. It is also about communicating with customers in a clear, professional, and controlled way so that the business actually collects the money. Teacher talk moment. A perfect receivables ledger is useless if nobody follows up properly and politely with customers. What the book means by customer communication. Customer communication means all the messages the business sends to customers and receives from customers about invoices and what is owed, payment terms and due dates, overdue reminders, disputes and corrections, credit limits and whether the account is on stop, statements of account and balance confirmations. In a computerized receivables system, this communication becomes easier because the system can produce documents and reports quickly. Why customer communication is important in receivables control. Reason 1, it improves cash flow. Clear reminders and statements encourage customers to pay on time. Reason 2, it reduces disputes. When customers can see a clear list of invoices, credit notes, and payments, there is less confusion. Reason 3, it supports credit control decisions. If the business needs to stop further credit, it must communicate that clearly and correctly using accurate ledger information. Reason 4, it protects customer relationships. Professional communication helps the business collect money without damaging long-term customer relationships. Credit control must be firm, but also respectful. Your goal is payment plus continued business, not arguments. What tools the computerized system provides for communication? The system helps communication mainly through reports and documents, such as 1. Sales invoices, so the customer knows what to pay. 2. Credit notes, so the customer sees the reduction in what they owe. 3. Statements of account, so the customer sees a summary over a period. 4. Aged receivables information, so the business can focus communication on the most overdue items first. 5. Customer details, so letters, emails, and calls go to the correct contact. What good communication looks like, step by step. Step 1. Confirm the facts before contacting the customer. Before you phone or email, check the customer account. Which invoices are outstanding, which are overdue, whether any credit notes are pending, whether any payments are unallocated. This prevents embarrassing mistakes. Step 2. Choose the correct type of message. If the debt is recent, a friendly reminder may be enough. If it is older, the message becomes firmer. If it is very old, the business may warn about stopping credit or taking stronger action. Step 3. Be specific. Good communication uses invoice references, dates, amounts, and a clear requested action, such as please pay by a specific date. Step 4. Record the communication. A good system or good procedure keeps a record of when you contacted the customer, what was agreed, and what the next follow-up date is. Teacher talk moment. If it is not recorded, it is easy for promises to disappear. Recording makes chasing effective. Common causes of communication problems and how this lesson helps. Problem 1. The customer says they did not receive the invoice. Solution. Resend it and confirm address and contact details. Problem 2. The customer says the invoice is wrong. Solution. Treat it as a dispute, investigate quickly, and issue a credit note or correction if needed. Problem 3. The customer promises to pay soon. Solution. Ask for a firm commitment, meaning a clear payment date and method. Problem 4. The business keeps supplying even though the customer is overdue. Solution. Use the receivables reports and credit limits to support a controlled decision and communicate clearly if the account is placed on stop. Exam recommendations for lesson 3.6. If the exam asks you to explain how a receivables system supports customer communication, use this structure. First, state what communication involves: invoices, statements, reminders, and dispute resolution. Second, explain how the computer system helps in. It can produce accurate documents and reports quickly using stored customer details and transaction history. Third, explain the benefit: faster collection, fewer disputes, better credit control, and more professional customer service. Fourth, add one control point: access to customer information and reports should be restricted to authorized staff because it is confidential. Quick class check question: if a customer says, "I do not agree with this invoice," what should you do first? You should say, check the customer account, identify the invoice details, treat it as a dispute, and investigate before chasing for payment. That completes lesson 3.6 only. Class. Now we are in lesson 4 of this chapter, irrecoverable debts. This lesson answers one very practical question. When a customer does not pay, and we genuinely believe there is no real prospect of collecting the money, how do we record that properly in the accounts? Lesson 4 is short in the book, but in real life it is a big topic because it affects profit, trade receivables, credit control decisions, and sometimes sales tax. Lesson 4 Introduction. What is an irrecoverable debt? An irrecoverable debt is a receivable that the business now believes will not be paid. In the textbook wording, the business decides there is no real prospect of payment, so the debt must be written off as a loss. Let us make that crystal clear. When we sell on credit, the customer owes us money. That amount sits inside trade receivables. If later we discover we will not receive it, we must stop pretending it is an asset that will bring future cash, so we remove it from trade receivables and recognize an expense, a loss. Common reasons the book gives for irrecoverable debts. The book gives typical reasons why a customer might never pay. 1. The customer has gone bankrupt. 2. The customer is out of business. 3. Dishonesty may be involved. 4. The customer is in another country and cannot pay because of foreign exchange control restrictions during the credit period. Notice what these reasons have in common. They are not slow payment. They are no payment. Quick class check. If a customer is simply late, do we write it off as irrecoverable? No. We chase it, we follow credit control, and we only write off when it is no longer realistically collectible. Lesson 4.1. Irrecoverable debts written off. Ledger accounting entries. Now we move to the key double entry. What accounts are involved? 1. An irrecoverable debts account in the general ledger. This is an expense. 2. The trade receivables general ledger account, also called the trade receivables control account. The double entry when we write off a debt as irrecoverable is debit, irrecoverable debts expense account, credit, trade receivables general ledger account. Meaning in plain language, debit the expense because we have suffered a loss. Credit trade receivables because the asset is no longer expected to turn into cash. Very important control point from the book. Any write-off of irrecoverable debt needs authorization of a senior official in the organization. Why does the book stress that? Because writing off debts can be abused. A dishonest employee could write off a friend's balance, or hide theft, or cover up poor credit control. So in exam thinking, when you see write-off, think authorization. Mini check question. Which side do we put the trade receivables control account on when we write off? We credit it because receivables go down. Lesson 4.2. Example, irrecoverable debts written off. The book gives an example with totals for a whole period. Let us walk it slowly, like you would do in an exam. Story in the example. At the start of the period, the 1st of October, year 20x7, total outstanding debts, trade receivables, are 8,600. During the year to the 30th of September, year 20x8, credit sales amount to 44,000 payments from customers, amount to 49,000. Two specific debts are declared irrecoverable, 180 and 420. First, combine the two irrecoverable debts. 180 plus 420 equals 600. Now think like an examiner. They want you to update the trade receivables control account and show the irrecoverable debts account. Trade receivables control account logic. Start with opening receivables. Debit balance brought down. $8,600. Add credit sales, because sales on credit increase receivables. Debit sales, $44,000. Subtract what customers paid. Cash received reduces receivables. Credit bank, $49,000. Subtract irrecoverable debts. Writing off reduces receivables. Credit irrecoverable debts written off, $600. Now we calculate the closing balance. Opening $8,600 plus sales $44,000 equals $52,600. Less payments $49,000 equals $3,600. Less irrecoverable debts $600 equals $3,000. So closing trade receivables equals $3,000. Teacher tip. In the exam, always do this as a clean running total, or use a T account with the correct side for each item. Irrecoverable debts expense account logic. This account is an expense. The book shows it as a T account fed by the write-off totals. Debit irrecoverable debts, $180. Debit irrecoverable debts, $420. Total expense equals $600. So profit is reduced by $600 because that is the loss for the period. Quick check question. Does writing off a debt reduce sales income? No. Sales happened. The customer simply did not pay. The loss is recorded as an expense, not as negative sales. Lesson 4.3, Irrecoverable Debts and Sales Tax. Now we add a complication. Sometimes the debt we wrote off included sales tax. For example, a tax like VAT. The book explains that a business may be able to claim relief on the sales tax part of an irrecoverable debt if certain conditions are met. The book lists conditions such as at least 6 months old from the time of supply written off in the accounts of the business. And the book reminds us, conditions vary according to local regulation. Why is this section here? Because when you originally made the sale, you treated the sales tax as tax you collected on behalf of the authorities. If the customer never pays you, you may not want to be left paying tax on money you never received. Some systems allow you to reclaim that tax element, but only after rules are satisfied. The double entry shown in the book for sales tax relief. Here is the structure of the entry when the irrecoverable debt includes sales tax and relief is allowed. Debit, sales tax account. This reduces the tax you owe or increases the tax recoverable. Debit, irrecoverable debts expense. This is now only the net loss excluding sales tax. Credit, trade receivables general ledger account. This removes the full gross amount owed. So we split the gross receivable into net sale element, which becomes the expense sales tax element, which is reversed through the tax account. Mini check. Why is trade receivables credited with the full amount? Because the customer owed the full invoice total, including the tax. Lesson 4.4. Example, irrecoverable debts and sales tax. The book then links back to the earlier example and says, if both irrecoverable debts were inclusive of sales tax, the accounts would look different. What changes? Trade receivables control account. No change in the credit total written off. We still remove $600 from receivables in total, but the debit side split changes. Instead of debiting irrecoverable debts with the full $600, we split it into net and tax. In the book's figures, the split is shown like this. Net irrecoverable amounts, 150 plus 350 equals 500. Sales tax amounts, 30 plus 70 equals 100. Gross write-off, 500 plus 100 equals 600. So the accounting meaning is debit irrecoverable debts, expense 500. Debit sales tax account, 100. Credit trade receivables control account, 600. Teacher talk. That is the key exam skill. When tax is included, the loss to profit is only the net amount, not the tax amount, assuming tax relief is permitted. Common exam mistakes to avoid in Lesson 4.1. Debiting sales instead of irrecoverable debts. Expense 2. Crediting the bank account when writing off. Bank is only used when cash is actually received. 3. Writing off a debt without reducing trade receivables. 4. When sales tax relief applies, charging the full gross amount as an expense instead of splitting net and tax. 5. Forgetting the authorization control point. Very short interactive practice. Pause and answer out loud. 1. When a debt becomes irrecoverable, trade receivables goes up or down. 2. Which account gets debited to record the loss? 3. If the irrecoverable amount includes sales tax and tax relief is allowed, do we debit the sales tax account or credit it? If you want, send me your 3 answers and I will check them quickly. And we stop here because lesson 5 is allowances for irrecoverable debts. And that is a different idea. It is about expected future losses, not confirmed write-offs. Now we are starting lesson 5, allowances for irrecoverable debts. This is one of the most exam-tested ideas in the receivables area because it forces you to think like a professional accountant, not like a cashier. In lesson 4, we dealt with irrecoverable debts that are already known and can be written off. Now lesson 5 asks a different question. What about the debts that are still in the receivables ledger, still unpaid, and not yet confirmed as irrecoverable, but we strongly suspect that some percentage will never be collected? That is where an allowance comes in. Lesson 5 in one simple sentence. An allowance for irrecoverable debts is an estimate of the part of trade receivables that is not expected to be collected. It is not a write-off. It is a cautious estimate made at the period end, so the accounts do not overstate receivables and do not overstate profit. Part 1. Why we need an allowance. Let me speak to you like a manager would speak to the accounts office. At the end of the year, the sales team says, "These customers owe us money. The receivables figure is high. We are doing great." But the credit controller says, "Yes, but some of these customers will not pay. If we pretend all will pay, we are lying to ourselves." So accounting takes the sensible middle position. We keep the receivables on the ledger because the customers still owe the amounts. But we reduce the reported value of receivables by an allowance because we do not expect full collection. This gives a more realistic figure in the statement of financial position. Part 2. 2 types of allowances mentioned in the book. The book highlights 2 broad approaches. 1. A specific allowance. This is where you look at one particular customer, you see a problem, and you estimate that a specific amount of their balance will not be collected. For example, a customer is in financial trouble or disputing an invoice or has been promising to pay for months. So you set an allowance just for that customer. 2. A general allowance, sometimes called a percentage allowance. This is where you do not know exactly which customers will fail. But based on past experience, you expect, for example, a small percentage of total receivables to become irrecoverable. So you take a percentage of receivables and create an allowance. Both are estimates. Neither is a write-off. Part 3. The key accounting treatment. Now I want you to hear this clearly because this is the exam rule. An increase in the allowance for irrecoverable debts is treated as an expense. So when we create an allowance or increase it, profit goes down. Why? Because we are recognizing that not all receivables will turn into cash, so we must not show that full amount as good news. Part 4. The double entry for creating or increasing the allowance. The entry is very simple, and you must learn it as a pattern. Debit irrecoverable debts expense, or allowance expense. Credit allowance for irrecoverable debts, sometimes called allowance for receivables. Let me explain what those 2 sides mean. Debit expense means we charge the expected loss into profit or loss. Credit allowance creates a contra-receivable balance. It sits against trade receivables and reduces the receivables figure shown in the statement of financial position. So we still keep the gross receivables balance, but we report trade receivables minus allowance equals net receivables. Part 5. What happens later when a specific customer is finally written off? This is where students often get confused. When you later decide a specific debt is definitely irrecoverable, you write it off. But if you already have an allowance, the write-off is normally charged against the allowance, not charged again as a fresh expense. So the write-off entry, when it is covered by the allowance, is debit allowance for irrecoverable debts, credit trade receivables. Notice what happens to profit here. Profit does not change at that moment because the expense was already recognized when you created the allowance earlier. That is exactly the logic of lesson 5. Part 6. The example idea. The book is illustrating. The book gives the type of situation you see in real life. A business makes credit sales during the year. It receives some cash from credit customers. Some debts are written off as irrecoverable. At the year end, there is still an outstanding receivables balance, but management expects a percentage of those outstanding receivables will eventually be irrecoverable. So the business creates an allowance, for example, 5% of the closing receivables. The meaning is, we have receivables outstanding, but we expect that only about 95% will actually be collected in cash. So the net receivables figure becomes smaller and more realistic. Part 7. The most common exam mistakes in Lesson 5. Mistake 1. Treating the allowance like a write-off. No, a write-off removes a customer debt from the ledger because it is confirmed irrecoverable. An allowance does not remove the debt. It is only an estimate made for reporting. Mistake 2. Using the allowance entry backwards. Remember the pattern. Expense is debited. Allowance is credited. If you reverse it, you will increase profit when you should be reducing it. Mistake 3. Calculating the percentage on the wrong base. In the exam, read carefully what the percentage is applied to. Sometimes it is on the closing receivables balance. Sometimes it is on closing receivables after writing off known irrecoverable debts. So always do the write-offs first if they happen before the year end, then calculate the allowance on what remains. Part 8. Quick exam technique you can use every time. When you see the word allowance, you should instantly ask yourself 3 questions. 1. Is this asking for the allowance required at the end of the period, or the increase or decrease in the allowance? 2. Is it a specific allowance, a general percentage, or both? 3. What is the net receivables figure after applying the allowance? If you answer those 3 questions, you can handle almost any exam question on this topic. Quick interactive check. Class, answer these out loud. 1. Is an allowance for irrecoverable debts a confirmed loss or an estimate? 2. When we create an allowance, does profit go up or down? 3. Which account is credited when we create an allowance? Trade receivables or allowance for irrecoverable debts? Send me your 3 answers, and then we will move to the next lesson with full confidence.